Welcome to our 2019 Year-End Planning for Investors two-part series. This overview will discuss interest rates. As you are probably aware, the Federal Reserve lowered interest rates by a quarter percentage point to a range of 2 to 2.25% in July of this year, and again by a quarter of a percentage in September to 1.75 to 2.0. July was the first time since 2008 that interest rates were actually lowered. With economic data and continued trade wars, analysts are expecting the Fed may lower interest rates yet again this year. However, this is still speculation, and Fed Chair Jerome Powell stated, "What we're seeing is that it's appropriate to adjust policy to a somewhat more accommodative stance over time, and that's how we're looking at it." For now, investors need to keep a watchful eye on interest rates. That makes this a good time for us to review your interest rate sensitive investments. This includes: Number 1, make sure you are comfortable with your time horizons and assess your risk tolerance. Are your interest rate sensitive investments compatible with both? As advisors, we help our clients review the income producing investments they own. Our primary goal is to try and match your portfolio to your timelines and personal financial situation. Number 2, maintain complete liquidity for all short-term and near-term needs. Liquid accounts in today's interest rate environment might not keep pace with inflation, although it is always important to maintain a liquid component in your portfolio. You should think about what major expenses you will incur in the next 2 years and consider keeping a reasonable liquid pool of assets. Number 3, we're reviewing your bond holdings duration. In bond investing, we talk about duration as a measure of a bond's sensitivity to interest rate changes. The longer the duration, the more a bond's price is impacted by interest rate changes. Typically, bonds with longer maturities have longer durations and vice versa. So investing in bonds with lower duration or shorter maturities can help to reduce your exposure to rising interest rates. Number 4, we are considering shorter terms over high yields. Although shorter term bonds could yield less than long-term bonds, they typically lose less value when rates rise. With long-term interest rates still historically low, we are being especially careful of longer-term bonds. Number 5, diversify. This can potentially reduce your risk and could possibly even provide greater portfolio stability during fluctuating markets. Investors are spooked by a scenario known as the inverted yield curve, which occurs when the interest rates on short-term bonds are higher than the interest rates paid by long-term bonds. As this chart shows, on January 2nd, 2019, 10-year Treasury yields were above 2-year yields, but on August 2nd, 10-year yields fell to at or below 2-year yields. Please keep in mind that interest rates are still low and might not help many investors reach their goals. Historically, an inverted yield curve has been viewed as an indicator of a pending economic recession because the 2-year, 10-year version of the yield curve has preceded each of the past 7 recessions, including the most recent slowdown between 2007 and 2009. This may or may not happen, and there are arguments supporting both sides of this theory. Thank you. We appreciate the opportunity to assist you with your financial needs. Please check back soon for our final overview on recession.